Okay, let's embark on this deep dive into Wall Street. We're using Fred Schwed Jr.'s classic, Where Are the Customers' Yachts, as our guide.
Right. And that title, it comes from this brilliant little story, doesn't it? So simple.
Yeah, just a visitor sees all these amazing yachts owned by the bankers and brokers and just innocently asks, okay, but where are the customers' yachts?
It's such a sharp question.
Yeah.
And, it's why the book's title has endured for, decades now.
Absolutely. It just cuts right to the core of something fundamental.
And we're looking at excerpts, specifically including the intro from the 55 bull market edition.
Which gives us a bit of context, how the book landed after its first publication.
And you get Schwed's flavor immediately. Skeptical.
Witty, definitely funny sometimes, but sharp too.
Yeah, and he tells you straight up, doesn't he, about the information quality.
He does. He says it's not guaranteed by us, has been obtained from sources which have not in the past proved particularly reliable. I love that.
Me too. And he avoids stuff he doesn't get, steers clear of what he calls economic deep thinking.
Which he basically sees as like glorified second guessing.
Exactly. And no heavy stats either. He thinks figures can force one part of the truth while ignoring the rest.
His goal is just to describe the people and the operations as they really are. Pretty direct.
And that's sort of our mission too, isn't it? To use his perspective, explore predictions, people, customers, investments, reform.
Right. And pull out those insights, those surprising bits that still feel relevant, hopefully giving you a clearer view of it all.
Okay, so where do we jump in first? Prediction seems like a big one for Schwed.
Oh, definitely. It feels just as relevant today, that whole obsession with forecasting.
And he paints the whole picture, doesn't he? From the really small scale.
Yeah, like the assistant order clerk, Mr. Joseph Weisenheimer leaning on the ticker, chewing gum.
Looking super shrewd, naturally.
Oh, yeah. Predicting a rally after lunch to these, super impressionable customers.
And then you've got the other end, the big shots, like S. Hugo Big.
Right, sending out his deep thoughts on all the wires, forecasting trends 15 years out.
So what's Schwed's actual verdict on all this crystal ball gazing?
It's pretty brutal. He basically says, pitifully few financial experts have ever known for 2 years, much less 15, what was going to happen.
And that the majority are usually spectacularly wrong in a much shorter time than that.
Ouch. Right, so it makes you wonder why the constant predicting if it's so often wrong.
Well, he digs into the psychology, suggests the immature mind tends to believe what it hopes is true.
He calls Wall Streeters romantics.
Yeah, in a business of dreams, always looking for that secret, that predictable pattern.
And there's a practical angle too, right? It's tough to just say, I don't know.
Oh, absolutely. When a customer asks what's next, you feel you need an answer. Predictions generate business, commissions.
Schwed says brokers often convince themselves first, sometimes badly.
Right, because they want to believe it's predictable. Even the runners, the delivery guys, have strong opinions, with nothing really at stake for them personally.
Maybe the most telling detail he uses is about, when a big, successful financier dies.
What happens when they open the safe deposit box?
The executors find bundles of the most hopeless securities, names long forgotten.
Wow. So even the legends made huge mistakes they couldn't or wouldn't fix.
Exactly. Suggests maybe even they didn't really know.
And the 29 crash? He calls that the supreme miscalculation.
Yeah, you had Andrew Mellon saying gentlemen prefer bonds just before. Or
Roger Babson, who called for a crash for years. Wrong. Until suddenly he was right.
It just hammers home Schwed's point. Predicting consistently. Probably impossible.
Okay, so if predicting is a losing game, what about the people actually in the game? Schwed has some memorable descriptions.
He really does. He starts with that classic conservative banker type.
The impressive specimen.
Right, whose main job is preserving fortunes made in more realistic businesses.
And his key skill, saying no.
Exactly, in various tones. He contrasts that with the bankers who actually have to say yes sometimes because their clients need money now.
And one thing he sees across the board on Wall Street, this sort of restlessness.
The inability to do nothing. That's such a great phrase.
Yeah. When there's nothing profitable happening, they can't just sit tight. They feel compelled to do something.
Even if it turns out to be, quote, extremely unprofitable, they're not lazy, just wired for action.
You see it with the brokers and customers men too, right?
Yeah.
Always needing to look busy.
Totally. On the phone, low voice, sounding important.
But really just talking about football scores.
Or the statisticians churning out market letters filled with this incredibly dense prose.
Like a German 19th century metaphysician, just to fill the space and make predictions they have to make.
And the language they use? It can justify anything after the fact.
Oh yeah. Well bought or well sold. Sounds smart, but only after you know the outcome.
Speaking of sounding smart, the chartists get a whole section.
Right. The pattern seekers. Head and shoulders. Double tops. They ignore all the actual business stuff.
It's all about the squiggles on the chart. History repeating itself.
And Schwed just dismisses it, basically calls it astrology. He notes they're often broke.
And their excuse, they didn't believe their own charts enough. It's brilliant.
He also talks about the money, the pay. Says Wall Street can be the highest paying place.
What?
But the money is often won or lost,
Yeah.
not really earned steadily, which makes accounting a nightmare.
You might not know what a firm is worth within millions.
Yeah. And that little story about the office boy and Mr. Z's briefcases.
Oh, that's great. The kid wonders if the boss ever opens them at those big meetings.
Finds out he doesn't. It just perfectly captures that performance of activity, maybe disconnected from real substance.
And his little aptitude test is funny, but also kind of revealing.
Yeah, questions about roulette, coin flips, poker, doubling stock prices, the purpose of a business.
It's a humorous poke at whether people actually grasp basic probability, risk, or even why companies exist.
Which leads us perfectly to the customers. Schwed definitely doesn't spare that hardy breed.
No, he looks at their motivations, how they operate, and, well, often how they crash and burn.
He says they come in all types, right? From the rich, supposedly savvy businessman,
Down to folks with tiny accounts running on pure hope, maybe desperation.
and how do brokers get these customers? It's not always sophisticated marketing.
No. Birth, marriage, being good at bridge, or golf.
Golf is better, apparently.
Hmm.
Shows a strong back. Might play a strong head.
Or just pure persistence, like Tommy by the door grabbing strangers.
And selling them 200 anaconda rights.
And just like the brokers, the customers' men, after the fact, claim they were never wrong once. Convenient memory.
One thing Americans seem to love, according to Schwed, is margin trading.
Oh, yeah. He compares it to mortgaging your house before you even own it, just to chase more than, 6%.
The logic seems tempting, doesn't it? If buying 100 shares for $1,000 is good.
Isn't buying 200 or 300 shares for that same $1,000 on margin even better? More bang for your buck.
Except it's not. And Schwed is adamant. The only way you learn this is the hard way.
With real money. Books can't teach you the feeling of losing important money.
It's experiential, like trying to explain childbirth to someone who hasn't gone through it.
He uses that Eddie Cantor quote, buying stock for old age and becoming old in a week.
And the 20th century limited train analogy, aiming for a small gain, ending up way off track in deep losses.
So what happens when the market turns and the margin call arrives? The dam bursts, he says.
And your options are pretty grim.
You've got the natural instinctive, basically. Tell the broker where to go, let them sell you out.
Then the finger in the dike, desperately throwing more money at the problem.
And the surprisingly common head in the sand. Just ignore the calls, the telegrams, hope it goes away.
He even mentions a customer who paid the margin call and insisted on paying for the collect telegram demanding it.
These stories lead him to diagnose this condition, rhinophobia.
Rhinophobia, the fear of having cash.
Exactly. People who just hate seeing cash sitting idle. They have to be invested, always.
Sell something at a profit. Immediately buy something else, maybe riskier.
So when the market tanks, they're fully invested. And they tank right along with it.
He tells that sad story of the customer who couldn't find the last $75 for a margin call.
And the rich guy who set aside safe Liberty bonds, but then threw them back into stocks when the market dipped temporarily, lost his safety net.
Beyond just money, though, Schwed sees these spiritual values for the customer.
Yeah, it feels like business, right? The thrill of potential profit without the actual hard work of running a company.
Contrasted with just earning a salary somewhere. But he notes dryly
that the stats, at least back then, showed staying home was often the most profitable move, just staying away from it all.
So if the customers are often acting against their own interests, what about the things they invest in, like investment trusts?
What we'd mostly call mutual funds today. He looks at the idea versus how they actually performed.
And the idea sounds great on paper. Pool money, get expert management, diversification. Perfect for the little guy.
But the reality, Schwed says they often fail to deliver. Why?
A few reasons. Sometimes just a lack of actual skill by the managers.
But it also conflicts of interest, right?
Big time. Like banking houses using their own trusts to dump securities they couldn't sell otherwise.
Or trusts tied to brokers just churning the portfolio to make commissions.
And even the honest ones, Schwed says, might just not be very bright in the head.
He does note the British and Scotch trusts did better.
Yeah, maybe because their goal was different. Conserve capital, produce income.
Not the American obsession with zip and quick riches.
He gives examples like the failed fixed trusts stuck with a list of best stocks that became terrible.
Or the cynical bank officer's ink spot test suggesting random picks might beat the experts.
And that incredible story of the office boy saving a trust $750,000.
Just by making a noise during the 29 panic, delaying a bad trade purely by accident. Pure luck.
He does find one exception, though. John W. Pope's Magical Investment Corporation.
Which actually made money during the crash, 1929 to 31.
How? By doing the opposite of everyone else. Holding cash, call loans, even shorting the market sometimes. Completely against the grain.
Okay, then he moves to options. Puts, calls, straddles.
These seem attractive too, especially if you have that rhinophobia, that fear of cash.
Right. It's a contract to buy or sell later at a set price. The big appeal.
Limited risk. Losing, say, $137.50 on a call option seems way better than potentially losing thousands on margin.
Schwed points out the paradox. The buyer, the seller, the broker, they all think they can win.
And he distinguishes between using options for hedging legitimate, he implies, versus sheer unadulterated speculation.
But then he kind of defends the pure gamble of speculative options.
Yeah, he argues, maybe controversially, that knowing your maximum loss up front with an option
is actually preferable to the unknown, potentially huge loss with margin, even if margin feels safer or more like investing. He questions margin's moral superiority.
But inevitably with Schwed, there's always the catch.
Always. And the catch with options.
They're just not a reliable way to make money. Costs add up, picking the right stock and time is super hard.
And even if you are profitable, he says whatever you do next sell, hold usually turns out to be wrong because of psychology.
And the final sobering thought before you buy that call option.
Remember, the person selling it to you is betting the stock won't go that high. Someone thinks you're wrong.
Okay, shifting gears a bit. Schwed looks back at history, manipulation, and reform. The good old days.
Which he defines very simply. They were just boom days.
And even though booms end badly, he senses Wall Street always secretly wants another little orgy.
Thinking this time they'll get it right.
He talks about the great captains of industry from those eras, often romantic figures.
Egotistical, risk takers, but maybe with questionable financial IQs long-term.
Yeah, failure to really grasp money realistically, he thinks.
And speculation itself, often just guessing, not wisdom.
He mentions tape readers, seeing secrets in the ticker.
And the guy testing the market by shorting thousands of shares just to see what happens. Pure gut feel.
He uses that brilliant coin-flipping analogy.
Right. Even with pure chance, some people will have winning streaks.
And the public, the press, they hail them as geniuses with special instinct.
When it's just statistics. Look.
Schwed also talks about that mysterious pronoun, they.
Ah, yes.
No,
They are pushing the market up, or they are selling the unseen forces.
he suggests by the late 20s, their actual power was probably less than people imagined, especially in big markets.
What about actual manipulation, like trying to pump a stock?
He discusses it, picking a stock with a story, trying to make it go up, using washed sales.
Which is basically fake trading to create activity, right? Illegal now.
Right. But Schwed says even that wasn't an easy way to get rich. He tells about the pool manager failing to hoist a stock, needing more cash from the group.
That bowl of nickels story captures the era perfectly.
Yeah, in the 1920s club cars, millionaires taking free nickels for the subway, a symbol of easy money.
That vanished overnight with the Depression, showing how fragile it all was.
Which brings us to reform. Needed, Schwed agrees, but often disappointing.
Or having unintended consequences, like fiduciaries getting too safe.
Yeah, investing for near zero returns just to avoid any risk or blame, playing it too safe.
He makes that sharp point comparing theft versus folly.
Right. Millions might be stolen, but billions are lost through people's own foolishness.
And the burnt customer prefers thinking they were robbed rather than admitting they were a fool following fools. Easier on the ego.
Regulating is hard too. He talks about the specialists on the exchange floor.
Trying to define what's necessary market activity versus ripping people off, it's tricky.
Like the specialist punished for bidding $5 for a stock opening at $2 in a panic? Was he supporting the market or just wrong?
Regulation has limits. Ending the envelope game kickbacks to clerks worked.
But apparently it hurt those clerks socially. Weird side effect.
And the SEC making prospectuses super detailed.
But unreadable. And it didn't stop losses and downturns anyway.
Schwed sees the SEC in a tough bind, representing a public wanting impossible safety.
Maybe leading to rules even the SEC doubts.
Right.
Trying to make the market forever gently rise.
He compares the SEC to a doctor with only one patient, the market, who can't really be cured, just experimented on. Again, that's just reporting Schwed's view from the source.
So after all this critique, does Schwed offer any kind of positive investment philosophy? What's the true game?
Well, he revisits investment versus speculation, says it's mostly a matter of degree.
Tied to the return you expect and the risk you take. High return hopes, speculation. Modest hopes, investment. Much better odds with the latter.
He does offer that little wonderful advice for the wealthy, tongue-in-cheek maybe.
Sell stocks, buy bonds when the market busts. Sell bonds, buy stocks when it booms.
History suggests it works splendidly, but
Psychologically, it's almost impossible to do. Buying when everyone's terrified, loving when they're euphoric.
yeah, someone has to buy from the suckers at the bottom, and it feels awful at the time.
He also stresses the difference between price and value.
Crucial distinction. Price is clear on the ticker. Value is fuzzy. Earnings, prospects, intangibles.
And focusing only on value can make you ignore price completely, like that Texan banker.
Who paid way over the market price because his firm focused only on value.
Ultimately, Schwed argues true wealth isn't the fluctuating balance, it's sustainable income.
Thinking in terms of £5,000 a year, what your investments reliably generate.
And your investment choices should align with how you plan to spend that income. Unrealistic spending needs.
Like needing high yield for little Paula's education.
Pushes you into riskier stuff, often unwisely.
And true to form, the book offers no easy answers, no constructive program.
No magic formula. Schwed seems to end with this sort of skeptical affection for the whole messy system, flaws and all.
Suggests the machinery should probably be kept, despite the nonsense.
And that joke about sending him $2 for the real secret to making money? Perfect.
Okay, so let's try to synthesize key takeaways from Schwed's view here.
Well, first, markets are fundamentally unpredictable, despite all the noise about forecasts.
Second, psychology is huge. Prediction bias, dreaming, that rhinophobia fear of cash, they drive bad decisions.
Third, history shows consistent success is incredibly hard, whether speculating or just standard investing via trusts or options.
Fourth, he skewers practices like margin and manipulation, showing they're often flawed or harder than they look.
And finally, reform is needed, but complicated, limited, and can have weird side effects.
Which brings us back full circle to the title, Where Are the Customers' Yachts?
And maybe the answer isn't just about crooks. Maybe it's also about the nature of the game itself.
Human psychology being what it is.
And the sheer difficulty of turning small stakes into fortunes reliably in a system that, well, resists easy answers.
So the final thought for you, listening. If Schwed is right about prediction and psychology being the biggest obstacles,
How much of financial success is really skill versus just luck? And what does that perspective, written decades ago but feeling so current, mean for how you approach things today?
if the game hasn't fundamentally changed, what are those enduring lessons from Schwed's witty, skeptical voice for you?